Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets, a great educator. He's going to be there to help answer your questions. Thanks to all of you for being here, whether you're here with us live or in the recorded version. We're grateful that you are part of our audience. Thanks for being a part of the discussion as well. Make sure that you chat in and leave some comments and have a part of the discussion. We're going to be talking about what's going on today in terms of volatility, number one. Number two, we're going to be managing our 14-7 strategy. We're going to talk a little bit about where we are perhaps in this week from an index movement perspective. So we've got a little bit of material to discuss today. A couple of quick housekeeping items as we get started. Remember that everything we talk about is simply for illustrative and educational purposes only, and is not a recommendation of any particular security or strategy or account type. Now, remember, investing involves risk, including the risk of the loss of principal. When we talk about trading options, including index options, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the risks and characteristics of standardized options before considering any option strategy. Remember that multiple leg option strategies can entail substantial transaction costs. Additionally, spread trades generally should be done or must be done in a margin account. Now, a couple of things we want to talk about. Primarily when we talk about index options, we're talking about European style options. Those European style options cannot be exercised, not bought and sold, but exercised until expiration, which means that there is not the risk of early assignment. However, if you're trading an American style option, that American style option can be exercised at any time prior to expiration. Therefore, if you're short an American style option, there is that possibility that you could be assigned prior to expiration. So just be aware of that. Now, I say that in the context of the fact that we're using our Thinkorswim desktop software platform and specifically the paper money version of that platform today, as we always do. Great learning environment, great sandbox to play in. However, there are some things that it does not do. It doesn't guarantee what's going to happen in the future. Number two, it doesn't guarantee that you're going to be successful, even if you're successful in trading paper money. And number three, it does not facilitate the early assignment of short options if they are American style options. So be aware of that as you move your practice from paper trading to live trading, just some of those differences. Also remember that, however you're looking at the market, whether it's theoretical probability analysis, whether it's fundamental analysis, whether it's technical analysis, all of those are theoretical in nature. None of those are guarantees. None of those guarantee what will happen in the future. Therefore, Schwab does not recommend the use of technical analysis as a sole means of investment research. Now, the other thing to think about, we may talk about it in this context, oftentimes we don't, but just a quick reminder for those of you who are using stop losses or considering using a stop order. Remember that a stop order allows you to specify the activation price, but not the execution price. And in the event of a stop limit order, there is the potential that the price of the stock or the index could gap around the stop order, in which case the order may not fill at all. So be aware of that as we get into this discussion. So a couple of things I want to talk about. We're going to talk about a brief review of index options, just as we normally do. We're going to talk about a couple of different strategies. We'll look at some examples on the platform. And then the other thing that I wanted to bring into this discussion is this. I have an idea, given the level of volatility and given the level of movement. Low volatility, lower volatility, or falling volatility begets the idea that the market maybe isn't moving very much. Market neutral movement oftentimes is met by strategies that bracket an area or a range. So we're going to talk a little bit about using index options for a relatively short-term iron condor type of trade today. We'll take a look at how that plays itself out here in this discussion. But that's just a quick primer for what we're going to do. Let's jump out to the Thinkorswim desktop software platform and see what is going on. And again, by the way, you've got that chat open out there in the discussion. You can participate in the chat. Cameron will answer your questions. You can also follow us on X. Cameron has nicely pinned that to the top of the chat panel there. You can follow us on X at Ben Watson CS, at Cameron May CS. All of the other coaches are similar naming conventions. Be aware that there are some imposters out there, so make sure that you are seeing the at Ben Watson CS or at Cameron May CS, and make sure that everything seems legit. I know those imposters getting more and more adept at imitation, which I guess is a sincere form of flattery, but I'd rather not have their flattery. I'd rather have your follow. So let's also, as we take a look at what's going on out here in the market, just let me quickly remind you to click on that subscribe button down there at the bottom of the page. And that gets you that subscription here to the Trader Talks webcast channel. Helps us out, helps you out, and it's at no cost to you. So let's jump into this discussion this morning. And I want to start over here on the left-hand side with the S&P 500. So let's kind of set the stage. Kevin Horner and I talked a little bit about this morning in the Trader Talks webcast, but we're kind of sandwiched here now between a Fed meeting today, which will end, and we'll get the news conference kind of right at the in the next webcast from this, but we'll start to get some information. And the idea is generally that the market's not likely to do much until we get some information or some change from the Fed. Now, is that likely to happen now? Is it likely to happen today? That's a good question. There's not a big expectation that the market is likely to move or that the Fed is likely to change policy and cut interest rates, although I know that's the hope of many people. But that expectation just isn't there. I'll show you the FedWatch, the CME FedWatch tool here in just a minute. But the market's kind of sitting at a support level. It's kind of squeezing. If we were to draw a couple of lines of support and resistance, we could probably argue that we've got this little kind of cobra pattern kind of building up here into this time frame, right? Kind of squeezing into that range. Not a lot of movement, not a lot of push from the RSI. If we take a look at the NASDAQ, we kind of have the same thing. That little bit of a squeeze. And here's the other thing to think about. We are ahead of a market holiday. The market is closed tomorrow for Juneteenth, for the Juneteenth holiday. That, combined with the fact that it's on a Thursday, combined with the fact that it's summertime, combined with the fact that we have a Fed meeting, is that the idea that maybe this market just kind of stays where it is, right? And as we look at the Russell 2000, the small caps kind of doing exactly the same thing. These indexes are kind of at these levels of support and resistance that have been previous levels of support and resistance. There's not a lot of oomph behind this market, not a lot of momentum, right? And so an expectation that the market may stay where it is. In fact, if we take a look at the VIX grid here, and I'm going to just bring up the VIX for just a second. This is the volatility index. You can see what's happened with the VIX. It's elevated. Yes, it's above its 30-period average. Yes, it's sitting at about the 19 handle. But I would argue that its 3-year average, its 5-year average, its 15-year average, it's about the 18 handle. So it's just a little bit elevated, and it is coming down today. Now, that does not mean that it's going to stay in that downward trajectory today. It could spike. News happens. News occurs without warning. That's what makes it news, right? And it could be unexpected. But I don't think the news is going to come from the Fed meeting unless there's something more significant, right? Geopolitically, we've got news going on. We've got geopolitical risk out there. We've got energy risk as a part of that geopolitical risk. So there is potential for movement, but at the same time, look, the fact that we've got a Fed meeting and then we've got a day off in the market and then we've got a Friday would suggest that maybe the market is looking to stretch this into a long weekend. And maybe we don't see a lot of movement between now and maybe next Monday, for instance. Okay, that's the premise that I'm going to go with in this perspective. So let's do two things. The first thing I'm going to do here is we're going to take a look at kind of that overall perspective. So I'm going to pop back over here and look at my monitor tab. And one of the things that we have done on a regular basis in this webcast, for those of you who are brand new, is every week we'll kind of continue this thread. But if I open up my Index Options Weekly, what we've done is we've sold a vertical spread, short-term vertical spread on the SPX using the S&P 500 index as our underlying instrument. Now remember, index options are cash settled because there is nothing to buy or sell. There's no long position in the index. There's no short position in the index. There is simply cash represented by that index because it is simply an idea that measures the components of that index, right? So the value of the SPX is that it is a cash settled index. It gives us something then to trade derivatives against. So what we typically do is sell the vertical spread at 14 days to go until expiration, and then buy the vertical spread back, come what may, at 7 days to go until expiration. And that allows us to take advantage of the disparity between time decay and the amount of premium that we're bringing in. There's a disparity between 14 days to go until expiration and 7 days to go. The rate of time decay at 14 days to go, in fact, is faster than the rate of time decay at 7 days to go for a far out of the money option. So we're taking advantage of that. So here we are. This is the one that we sold last Wednesday. We sold the June 25, so that expires next Wednesday, 58.65 put. And we bought the June 58.45 put. We created a vertical spread that was 20 points wide. We brought in $1.90. The reason we made it 20 points wide, which we know increases our risk in the trade, is that it also gives us a little bit more premium because it's cheaper to buy that longer or that further out of the money protection against the short option. So we sold it for $1.90. It's currently trading for $2.30. For a couple of different reasons. One, and probably the primary reason, is implied volatility was down here at 16%, at the 16 level when we sold this. It is now at the 19 level. And so you can see the influence of implied volatility on these trades. Time decay has happened. This was moving in the right direction, but time decay has happened. And therefore, this option has gained a little bit of value. It's gained, in fact, about 40 cents since we sold it to begin with. But remember, this is the premise of this strategy is come what may. So we're going to take this trade-off regardless. And I know, look, we know that there are lots of variations. We could have put a stop on it if we wanted to. It's already risk defined. We could have put a take profit order on it. Great, that's fine too. And you're certainly welcome to do that. There's nothing wrong with that. We're simply taking this trade come what may. Win or lose, just so that we can see the nature of how this works. So you may, as you've been trading vertical spreads or index options, you may run into the same situation where you've sold an option or you sold a spread and it just doesn't go your way. And you've presented with a lot of different potential choices for managing that trade. Sometimes it's simply better to cut and run, cut the trade short, eliminate the loss, and then move on and redeploy that risk at some other point. And that's what we're going to do here in this particular case. So $1.90 is what we sold it for. We're going to buy it back for $2.30 thereabouts. And so we're going to potentially suffer a $40 loss in this trade. Sometimes we have losing trades. In the immortal words of the pitcher Nuke LaLoosh in Bull Durham, sometimes you win. Actually, it comes from Crash Davis. But sometimes you win, sometimes you lose, and sometimes it rains. So in this particular case, sometimes we take a loss in this particular trade. So yes, we could roll it. We can initiate this as a roll, but I'm going to just simply do this for the... Yeah, Jerry, and that's a good point, right? So if we look at probabilities, these are generally very probable trades, like 80 to 90% probability in terms of our deltas. But sometimes we're taking a loss. And the reason for that is market movement and implied volatility increases, and those changes can happen. And so we know that. The rate of success in terms of the number of successful trades has been greater than the number of losing trades. But when we do take a loss, and I think this is a good lesson, right? When we do take a loss, sometimes those losses have been big. So that is a potential. Now, Joe asked the question, if you believe the trade will continue to work, do you continue to hold on or do you just follow the rules? I'm going to leave the answer to that question entirely up to you, because that speaks to your trader mentality, right? Do you look at sticking with something that is moving in the direction you want it to move, or do you follow your rules and take the trade off when you take the trade off for that perspective? So we're going to go ahead and we're going to close this out. So I'm going to do this. I'm going to create a closing order. I right-clicked on it here on the monitor tab. I'm going to buy that vertical spread back, and I'm going to work it a little bit, see if we can work it back down. Maybe we'll work it down to a $2.25 and see if we can get this filled. It's a liquid market right now. There's not a lot of trading volume, but it's still a liquid market. I'm going to go ahead and see if we can get it. Now, the market's moving on us just a little bit here. It moved down to 230, 240. Now it's 230 by 250, so it's widening a little bit. Again, we're getting closer to the Fed meeting, so maybe there's a little bit more volatility kind of bleeding back in here in this particular case. And I'm going to go ahead and see if we can work this to 225. We'll fire that order off and see if that fills. If it doesn't fill right away, like in the next couple of minutes here, then I'm going to come back over here to this working orders section in my monitor tab. I'm going to cancel and replace this order on my vertical spread. Nope, that's MGM. Let's go back to our monitor tab. I was on the wrong one. Here it is. See, let's make sure we're in the, there we go. I think now we go. Did it fill? No, it didn't fill. Did I even send it? Let's try that again, because it didn't fall into working orders. And let's just make sure I'm in the right account. Yes. It didn't sit there as a working order. MGM. Let's just make sure that we're on the right one. Okay, follow me. Now, guys, honestly, this is something that can happen, right? So right click, create closing order. We're going to put that order in. I'm going to work that order a little bit here. And we're going to go ahead and we're going to try to work this off. There it is right there. And let's go ahead and make sure we're in the right account. Make sure it says to close. And we're going to fire that order off. Now, if we go to the monitor tab, there it is right there. For some reason, I must have hit cancel. So now we're going to do cancel and replace. We're going to kind of work this. We're going to open that lock a little bit here. Confirm and send. We'll see if this fills. We'll make sure this goes in the right place. Index options weekly. I just wanted to go through that one more time, and we'll see if that gets. We got it for $2.30, which is fine. I was hoping that we could. Yes, you're right. I did, PL. Thank you for catching that. That's apparently what I did. And sometimes that happens, guys. That is a great lesson. And I'm glad sometimes we demonstrate these things through our own foibles, right? Because human nature says we're sometimes not going to press the right button. So if you ever wonder, and let me just kind of take a half step here at the moment. If you ever wonder why there might be a potential and why we talk about the potential, I know from a logical standpoint, it doesn't make sense that somebody would choose to exercise an option at a circumstance that maybe doesn't make logical sense from an intrinsic value standpoint or from a time remaining standpoint. But sometimes somebody might press the wrong button, and that can happen. And we see that here in this particular case, right? That sometimes inadvertent button presses can result in an early assignment for somebody else. Now, that's one of the reasons why, one of the benefits potentially for trading index options. I'm not recommending that you trade index options. I'm simply illustrating this. But at the same time, index options remove that early assignment risk. So that is a feature of index options that you may want to consider if that is a circumstance that you want to be aware of. So now let's take a look at how we might go about initiating our next trade in this perspective. So I'm going to change this grid to our index grid. And here it is right here, our index options grid. This is essentially two charts. Left-hand side is a 1-year daily chart. Right-hand side is a 3-month daily chart. Yeah, Ricebird, me too, all the time. You've seen it right here on this example. So I'm going to do is this. I'm going to take that line off. You notice where we sold the last one. And that's that hash mark that I put there on the chart, right? And you can kind of see what's been going on with those hash marks. They've been moving closer and closer in as volatility has been contracting. So as volatility is contracted, where we've been selling these spreads has come in, and you can see how it's come closer to where the price of the index is. So the last time we sold this, it was fairly close. And again, that's one of the reasons why with low volatility, we're not collecting as much premium, we're not able to sell as far out, why there's the greater potential for loss in a short or kind of a slow market, because that volatility contracts and volatility can then expand, right? So let's see where we are right now. We know that the level of volatility is a little bit higher, even though it's coming back down. So what I'm going to do is I'm going to go out to my trade tab, and we're going to look at 14 days out. We know that 14 days out is the 2nd of July. That's 14 days to go until expiration. So I'm going to go to my chart again, and I'm going to make my time hack, kind of that line, that vertical line. I'm going to use this tool right here. This is time level, and it's going to put a vertical line on the chart at the time that I select. So we're going to go out to July 2nd. Here's July 2nd, and I'm just going to put that line right there. There's my July 2nd line. Now, the next thing I'm going to do to determine where I sell this spread is I'm going to look for that intersection between that time hack and my probability of expiring cone. That probability of expiring cone, that purple line, is 1 standard deviation away from the price. That's the typical range of movement. Now, you could use also ATR. You could use a volatility, you could use Keltner channels, you could use Bollinger Bands, a lot of different ways to approach this. But we're going to use 1 standard deviation, and that's that probability of expiring cone that expresses that. So now, look at what's going on. Remember we said that volatility is expanding? So look at what's gone on with volatility, right? Volatility was pretty high. We were far away from where the price was. Volatility started to contract. Whoops. Volatility started to contract, so it got closer. Volatility is now expanding, so now we're a little bit further away. That's that relationship of volatility to that 1 standard deviation level, and why when volatility is low, we're selling closer to the price of the index. When volatility is higher, we're selling further away from the price of the index. So our short leg, very likely here around this 57.80 mark. Now that we know that, oh, by the way, the other thing, for those of you who are brand new, there's one other factor that we consider here. You see this blue line on the left-hand side? That's the 200 period moving average on this index. And that's a toggle, because we toggle, right? We toggle when the index itself is above the 200 period moving average, we sell put spreads. When the index is below the 200 period moving average, like it was up here or down here, we sell call spreads. So it's just a directional toggle. And Harry asks a great question, right? Should we consider buying spreads when volatility is low? That's a possibility. We could think about that. Maybe we could do a parallel comparison of these two. We might consider doing that. So Harry, thank you for that comment. That's a good thought. So we're at 57.80. We're going to go back to the trade tab. We're going to go out to the 2 July expiration, which is 14 days to go until expiration. I'm probably going to have to add some strikes here. I'm going to add another 50 strikes. So that's going to be 50 up, 50 down from the at the money strike. And we're going to go to the 57.80 strike. Here's the 57.80 strike. And you notice that's about the 16-cent delta. So think about that in terms of probability. That's about a 16% probability of being in the money at expiration. And a pretty high probability of being out of the money expiration, right? Theta is accelerated, pretty big theta number. pretty big volatility sensitivity too, however, right? Now, I also put in here, just for the standpoint of completeness, I put in here the option Greek rho, R-H-O. Rho is the measurement of the sensitivity of the option premium to changes in interest rates. I did that because we have the potential for a change in interest rates. Not the likelihood, but we have the potential. So I just wanted you to see, and I talked about this yesterday in the long options webcast. We talked about buying LEAPS options and having to consider rho impact, the possibility of an interest rate change. If interest rates were dropped 1%, we'd lose 39 cents out of this premium, is essentially what that means. So the likelihood of a 1% cut in interest rates today is extremely low. In fact, 0.001% if you look at the CME FedWatch tool, but it's not zero. So there is that possibility. So take that with a grain of salt, but I wanted to show you how you would measure that sensitivity to changes in interest rates. It's with the option Greek rho. So we're going to look at selling the 5780, this one right here. We're going to sell the 5780 for $22.50, and we're going to buy the 5760. So we're going to keep it 20 points wide. And now we're getting $1.95. Now that's a little bit more than we got last time for selling it. It's not as much as we've gotten before. So we'll see if we can work this and maybe get $2 out of it as this kind of bounces back and forth. So we're going to go ahead and we're going to click on confirm and send. We're going to read through this order, make sure that this is what we want, and we're going to go here to our Index Options Weekly. Now this is where the questions come up, right? Oh, well, I only have the potential to make $1.90 or $2 in the trade against a maximum theoretical loss of $1,810, right? So yeah, I mean, it's widespread. There is the potential. So how would we potentially see that maximum theoretical loss? If we were to let this trade go all the way through till expiration and it were both of these legs were in the money, which would mean that the market would have to move down below the 5760 and we were to leave this trade there, right? We could likely realize some of this indication, some of this potential maximum loss if we were to close the trade down at 7 days, right? So if the market moves down or so forth, right? And MBH says there is a dividend payment due soon on the SPX. And so there is that potential dividend risk in terms of the index as well. So there is, as you get that move, that's likely to move the market down a little bit, right? Okay. Rho and beta are somewhat, I'm going to have to explore that. That's an interesting question, Greg. Rho and beta being similar. Let's put a pin in that. In fact, do me a favor, hit me up over on X at Ben Watson CS with that, if you wouldn't mind, Greg, and throw that out to me and see what we might come up with on that. And you're right. See, these are not big winners, 10% winner, right? But if we can do this again and again and again and again, if there's directional movement, where we see the foibles of this is in the transition. We're not at a transition point. So again, likelihood of potentially seeing that maximum gain. Not a big winner, but it is, the potential consistency here. So in terms of putting that trade, right? So I'm going to do this. I'm going to go ahead and we're going to click on send. We're going to fire this order off. And I probably talked for $1.90, which is a little bit less than we were originally looking at, but that's okay. Sometimes that happens. So now here's what we've got. We're going to go back to our monitor tab, and we're going to close those down, and we're going to take a look here. This is the one that we closed. Here's the one that we sold for $1.90, and our expectation is this is going to get cheap quick. If the market moves higher, that's going to get cheap faster. If the market stays where it is, it's going to get cheaper, but it's going to take a while, maybe to next week. If implied volatility increases, it's going to get more expensive. If implied volatility goes down, however, back down towards its mean, then this is going to get cheaper. And we can kind of see it bouncing around there. So that's the thought process in this particular spread. And generally, and you're right, Alex. Yeah, I mean, we're at a delta of 17. 17-cent delta. Way out of the money. Can it still be hit? Yes, we've seen it happen. We saw it happen. As a matter of fact, we saw it happen on not this last Fed meeting, but the Fed meeting before that. And I made these words a part of my legacy. I said, hey, maybe the only way that we get hit on this particular trade is if there is a rip your face off rally. And then guess what? There was a rip your face off rally, not the next day, but later that same afternoon that I said that. And some of you were in the webcast that I was teaching later in the day, and you saw me acknowledge that fact that there was, in fact, a rip your face off rally, and that put our trade at that point in the money, deep in the money, and we ended up taking the max theoretical loss on that trade. So it can happen. 100% can happen. So be aware of that fact, that even if it's a 17-cent delta, it can still get hit. But what we can't have in this case is early assignment, right? An early assignment, which is what allows us the flexibility of trading this to this structure, right? So now let's do this. I'm going to come back over here to our market grid, or to our index options here. We're going to go to, I've got a couple of other things here. And yes, we'll talk about a long call diagonal, but I happen to have this trade right here, which is a long put diagonal on the Russell 2000. So this was a long put that we bought quite a while ago as a part of another multiple leg trade. We in fact bought back the original short put against this. Now we're left with this 12 days to go until expiration, deep in the money, 2030 strike put option that expires on the 30th of June. It's now worth about $10 roughly. We initially paid $33 for it. But what's been happening is we've been bringing in premium every week by selling against this. So this is going to go back to Martin's question. This is going to be a kind of a similar analog to that, right? So we've been selling premium. We've been selling like $3, $4, $3, $3, $3, $3, and pretty soon we've eaten away at a fair amount of that premium that we originally paid for this option. So let's see what we could get for selling another short-term put option against this long put. It's almost the time where this is going to be done, right? But to be fair, it's decayed away a lot of the decay that it's going to get, even though it's deep in the money. There's not a lot of extrinsic value left in that option, so there's not much of an impact from time decay. But at the same time, we've also bought down, by selling those premiums against this, we've bought down kind of a lot of the value of that option. So it's not really a $33 long put option. It was initially when we paid for it, but we've brought in premium against that. Now it's worth 10. If we were to buy it back, or to sell it back right now, we'd realize about $10.05 just from the sale of that, but we've brought premium in, but we'd lose the opportunity for another couple of rolls or another couple of sales against it. So let's go to the trade tab here for RUT. And here's the option that we're long. It's the 30 June put option, and we'll scroll down here. And now it is, I'm sorry, in this case, out of the money. Sorry, not deep in the money, but it's out of the money. So same thing, right? It doesn't have a lot of extrinsic value left, has no intrinsic value left. So here's what we're going to do. We're going to look at selling against this and essentially turning this into a short put diagonal. We're going to expect that the price is going to continue to move sideways or down in this particular case. And we're going to use this as the hedge against that. So, or the offset in terms of defining the risk. So what I'm going to do is I'm going to come back down here and I'm going to look for the expiration that has higher volatility. Now, I could do this as a 0 days till expiration trade. I could sell a put option against that just for today, right? That would expire, or we would buy it back today, simply. There might be a challenge. In initiating that trade, there's no guarantee that we're going to be able to put that trade on if we were to put this trade on. Number one, because of that possibility of adverse movement, there is the possibility that the brokerage would simply say, with the possibility of adverse movement, we're not going to initiate this trade. There's the possibility that we get wider bid-ask spreads because of volatility and because of quick market movement. So no guarantees that we could get this trade on, although we could sell this, right? We're short the 2030, long the 2030, and we could come down and we could sell something maybe still low probability, right? And bring in a little bit of premium for 1 day's worth of time. That's a possibility as well. 0 DTE, we know that at the end of the day, this is going to be either worth intrinsic or it's going to be worth nothing, right? That's the one of the things about 0 DTE options. But remember, even with an index option, that brings some potential risk for big movement on the last day of that premium or that option. But here's my argument. Every option held to expiration becomes a 0 DTE option at the last day of its trading. So put it all into perspective. So we could come out here to 2 days to go until expiration. There's a little bit higher implied volatility at that point. And so we could look at selling an option, a little bit more time to move, but also a little bit more time to recover if it does move. So we're long the 2030. So we could come in here and let's say we go to, for instance, the 20 delta, the 19 cent delta, the 2075. Now our expected move is 42 points, right? So expected move based on that level of implied volatility over the next 2 days is 42 points. Market is currently sitting at 21.20. So let's do this. It's currently sitting at 21.24. So 21.24 minus 42 points would put us at the 2082 strike. So if we were to go to the 2080, let's go in a little bit. That's going to put us again right here at about the 2075, 2080 strike and about a 19 cent delta. So for 2 days, now we're more than doubling what we're bringing in for selling that put option. So that original. So now here we are. We're going to sell this for about $5.60. And that's going to go against, if we click on confirm and send, we put this in our index options group and click on send. Now we've just reinitiated because we're still long that put option with 13 days to go, 12 days to go until expiration. Now we're short an option here at the 220 strike. So if we do this, if we go over here to the the analyze tab, and we take a look at RUT and we take this trade out of the equation, we're kind of working our way back into this trade. So here's what we've got. There's our short dated one. Here's our long dated one, and we're eating our way back here to potential profitability in this trade. So that's kind of what we're looking at doing in this case. All right. Now, here's what we're going to look at doing. Again, because of that potential for neutrality, I'm going to go back to our chart mode here. We're going to take a look at the Russell 2000. Actually, you know what? I'm going to do this to the point here. I'm going to do this on X. You know what? Let's do this on the NASDAQ. I was going to do it on the NDX. Let's do it on the NDX because I think we have a potential for some neutrality here, just like we do in the Russell 2000, right? But we've got negative momentum. We've got a rising 200 period moving average. We've got kind of support and resistance levels kind of squeezing this in. So what I'm going to do is I'm going to look at selling an iron condor here on the NDX. Now, we're going to look at a couple of different choices. So I'm going to go to the trade tab for the NDX. And I'm going to come out and I'm going to say, look, we've got 2 days to go until the end of the week. I'm going to make this a short-term iron condor. Not really super elevated implied volatility. We're going to do the same kind of thing. So I'm going to come down here and I'm going to say, all right, what's the expected move? 322 points. So the NDX is currently trading at 2182, or excuse me, 2,108.21. And so we're going to subtract from that. We'll call it 322. 322. That means 2149, so about the 21,500 level is our put side. So 21,500 is right here. That's a 20 cent delta. So what we're going to do is we're going to look at selling 21,500 put, and we're going to make this 20 wide. So we're going to go to a 21,480 put and we're going to get $2.40 of credit. Okay. If we were to just leave it here as a short vertical spread, right? A short put vertical spread, you're thinking, wow, these are big premiums. But if we did this, we did confirm and send. So look, we're bringing in $290 against $1,700 at an 80% probability of success on this side of the equation. Now we can do a little bit better. So what we're going to do, we're going to keep that there, but we're going to come over here to the call side. So we're going to go on the call side. We're going to say, all right, where's our index? It's at 2187, excuse me, 21827, 21827. And we're going to add to that 322 points. That would put our strike price at about 22,149 or about 22,150. We'll just round it. Traders like to round. 21, what did we say? 22,150. 22,150. So we're going to go to 22,150. 22,150 is also the 20-cent delta. Imagine that. And we're going to sell that one for about $22. And we're going to come back, and that was the 22,150, and we're going to go to the 22,170. So keeping it 20 points wide. Now we're bringing in $6.45, $6.85 on a 20 wide vertical spread. So if we click confirm and send, you see the change here? Now we're bringing in more premium for a little bit less, a little bit lower loss, right? And this is European style, right? So we don't have to worry about early assignment risk. We don't have to worry about it waffling up and down and maybe getting tagged on one side or the other. What we do have to worry about is a big move one way or the other, a big move outside this range between our break-even points, 21,493 and 22,156. So what I'm going to do is I'm going to come down here and edit, and I'm going to right-click and send this to our Analyze tab. Here it is on the Analyze tab. Our expiration is the 20th of June. So what I'm going to do is I'm going to change my range of probability out to the 21st. And you can see that the majority of this range of theoretical maximum gain in this trade falls kind of right in the fat middle section of that probability range, bringing in $6.65 of credit. Now, the problem with this, the challenge with this, in terms of closing this trade down, you've got 4 legs. So you've got 4 bid-ask spreads. If this moves, those bid-ask spreads may widen out. One of the other challenges is if price starts to move one direction or the other, one side or the other is going to get cheaper, the other side is going to get more expensive. We want both of these to be cheap. So there is some wisdom theoretically in closing one side down as the other side gets threatened. So if this starts to go down, if the index starts to go down towards our short side or towards our put side, we may think about closing down the put vertical side of this equation. And likewise, if it goes the other direction, we might look at selling or closing down the other side, buying it back. Standard kind of thought process around iron condors. The only difference here from any other iron condor that we might look at is this does not have that early assignment risk because it's on an index. So we've got a wide landing range of max theoretical gain. We're bringing in a fair amount of premium in this particular case against a defined risk trade. Now you could unbalance this, you could shift it around, that whatever you wanted to do. Lots of different ways that you can trade iron condors. So I'm going to go ahead and I'm going to click on confirm and send, read through this order, and we're going to put this order in our index options group. And we're going to go ahead and we're going to click on send, and we'll see if we can get this filled. So that's one of the questions. One of the challenges is getting a big iron condor, right? And see, if you could get out of this for that 50% of that theoretical maximum gain, you could do that too, right? And we could put a gain on that, right? Now, there's not a lot of time. So we're not in here for a long time. The market, the index doesn't have to stay within that range for a long period of time. Now, one thing I wanted to mention to you, if you wanted to learn a little bit more about these webcasts and some of the things we talked about, this tool right here, this is cmegroup.com. Is of a Fed interest rate change. This is a third-party provider. So that information is coming from a third-party provider. It is not provided by Charles Schwab. It's coming from the CME Group. But if you want to learn more about things like iron condors, you can come right here to the Trader Talks webcast page and type in iron condor and hit that right there. Now you've got a whole bunch of stuff about trading iron condors, right? So computation of settlement of the index, it's going to be based on the index, right? Not the individual positions within the index. So it's going to be based on the index number. Good question, Bruce. Again, yeah, and this would expire at the close of market on Friday. So cool. We talked about a lot of stuff today. My thanks to Cameron May for helping out. Remember to follow us on the X. Remember to follow us and click on that subscribe button. Regardless, my thanks to our great production staff, Andrew and Gabe, and Julie and Lindsay and Bree and everybody else that helps out with those, and our great reviewers. Thanks to all of you guys, and have a great day. We'll see you back here again next Wednesday for index options once again. Lots of great webcasts coming up the rest of the day. We'll see you soon. Take care, everybody. Bye-bye.